Welcome to Money Hangout once again. Every week we talk about a burning issue or something which is being talked about generally in the surrounding, or you're curious about or anxious about, and try and take your questions, as many as possible, relating to that area. And this is brought to you by Birla Sun Life Mutual Fund and Value Research every week. Today we are going to talk about something which was discussed very recently, 2 weeks back, by Warren Buffett. Should you invest in index fund? He gave a very simple advice to his wife that after his death, all his money can well be invested in an index fund. Index funds are very popular all over the world, at least in the developed market, and that is where we seek our guidance from, because they are older markets, more mature market, and most of our learnings or knowledge is derived from that. So there is a growing awareness about index being a very popular way of investing. It's a simple way of investing. Should you invest in an index fund? Why they are so popular elsewhere? Why they are not so popular in India? Why they are popular in elsewhere, and why most funds actually struggle to beat the index in many geographies, and why many funds actually are easily able to beat the benchmark. Defeating the index for Indian funds has not been very difficult. That is primarily the reason why index funds are not so popular in India. But first and foremost, let me just explain you what is an index fund. Index fund, when we entrust our money to a fund manager, we are telling him that you buy and sell things which you like, which you think are more promising. When you invest in an index fund, you are basically saying the fund manager that invest exactly like the index. So at any given point, if you look at the popular index, the Sensex or the Nifty, Sensex is a collection of 30 stocks in a certain ratio. So the moment you put your money in an index fund which is tracking the Sensex, the money will be invested in 30 stocks and exactly in the same proportion as the weightage of respective stocks in that index. So your daily gain and daily losses will be very much in line with you. If index goes up by 1% a day, then your money will actually grow by 1%. If it goes down by 1%, your money will go down by 1%. Your investment performance will replicate the performance of the index. Of course, there will be a nominal difference, because index fund will have an expense while index is not adjusted for the expense. And so the index funds are able to deliver you the promise of delivering as much as the market as tracked by that index. So you are assured of one thing, that you will not ever underperform. Of course, it is a compromise in a sense that you are going to index is an average, and index is going to be an average. So you reconcile with the fact that you will be an average performer. But even average performer with a rising asset class, or with a asset class which will grow over time, is not a bad deal. The real advantage of index fund which is being talked about is that there are too many funds, and many funds, it is hard to find the fund which will beat the index. Number two, you are assured of what you are going to it's a very predictable portfolio. When you buy an index fund, you know what this index will have, what is the methodology which will guide the constituents of the index. So you are assured of that. There is absolutely no dependence on a person. Funds can actually witness fund managers moving in and out of a fund. Fund managers can leave for another job. In index fund, you can be assured of the consistency of the process, or expectation of what you should expect. Third, and perhaps not actually the third, the foremost thing is that it is considered low cost, because it does not require a person, and the money, the very simple process of investing exactly in the same weightage as the index is pretty straightforward. So index funds are low cost, not as low cost in India, but in fact, in a global parlance, the largest index fund being managed is managed at 7 basis point cost. That is really low. It is one seventh hundredth of a percentage is the cost of the largest index fund managed by Vanguard. So that is really low, and so low cost fund management, diversification, convenience, the assurance of earning as much as the market, as in the as reflected in the index, is a great promise. They are popular there also because there are a variety of reasons why index funds are popular and why they work there. I will tell you more about why they haven't worked in India so far. In India, most of our funds, most actively managed funds, have been able to beat the benchmark, beat the index, beat the broad index, and even the smaller, even the small cap, mid cap indices were beaten by the benchmark, by the active fund manager by a wide margin. The primary reason is that the Indian universe is narrow. Indian universe, the number of investors, the scale of institutionalization. By institutionalization, I mean that the number of institutions investing in the market, they never used to dominate the Indian market. Only in the last 4 or 5 years, we have seen the emergence of the domestic insurance company of a fairly diverse kind. We have seen the emergence of mutual funds, which are becoming reasonable force in the marketplace. Otherwise, the scale of institutionalization in India was that we had a UTI and we had a LIC, and they used to dominate the Indian market for decades. Things are changing. Now we have large number of professional investors who drive the Indian market, and now we also have fairly large segment of foreign investors bidding, valuing their stocks, their preferences getting reflected in their choice. So that has brought about some degree of efficiency. But I think for indexing to work, the primary reason why indexing has worked very well elsewhere in the developed market is that there is a far greater institutionalization. In fact, good part of the long-term money abroad, mainly in the US and the UK, is channelized through institutions. The other is that their long-term savings gets channelized with regular periodicity, which is the 401k plan. A good part of it actually finds its way into the index fund because that's the easiest way, and it has gained popularity. Third is that even those economies are completely market oriented, they have all parts of the market, all parts of the economy, which is in the public domain and is being actively traded. We have, in India is not so. We have a good part of our economy which is still not in the public domain. We have a large number of public sector companies also. So if you want to buy all kind of companies, it is not possible to do so in India. Also, the other disadvantage is that there are a good part of the market, good part of the Indian economy, which is listed abroad, not so in India. A lot of goods and services that we buy are not available to, if you want to be owner of those companies, it's not possible to be so for Indian investors. With ease, in a limited way, you can do that. So the reason for popularity of indexing elsewhere is different, and the reason why it is not popular is pretty simple. It is easy to buy an index fund, and index funds have a reasonable case because of their low cost, because of their institutionalization, and because of the dynamics of those markets. In India, it has been the opposite. Index funds are not low cost. In fact, the open-end index fund, they cost as much as 1.5%. Some of the ETFs, they cost 0.5% or maybe little lower, but if you add the transaction cost, because to buy those ETFs you have to pay the brokerage. So if you add to that brokerage, they are no longer as low cost as they are elsewhere in the world. The other is that the index options are also not very wide. You can't buy a small cap index, or you can't buy a pure mid cap index, and it has. So I think it's also a self-fulfilling prophecy. When something becomes popular, then you have a reasonable supply. Because if they are not popular, so they are not being provided to investors in India. Third thing is that we don't have long-term money finding its way into index, and that is something which is changing a little bit. Now we know that Employee Provident Fund organization has started investing. This year it will be investing 18,000 crore uh, into equity market, and its primary investment will be in the index, will be an index fund, will be an index ETF. So as more and more long-term money comes into index funds, they gain popularity, and then it becomes a self-fulfilling prophecy. That actually initiates a virtuous cycle, that more money comes into those funds, and the underlying stocks actually go up in value. So that is happening at a very small pace. So right now, or if when I look at on a 5-year basis, on a 10-year basis, I find that actively managed funds are able to beat the benchmark by a wide margin. When this will be the real test, as and when it becomes very difficult for funds to beat the index will gain popularity. Right now, they have not been so. There are some early symptoms available that they might gain popularity. Some of those variables are falling in place, but still early days. I keep watching. I think we will keep revisiting this subject over years. And right now, choose your well managed equity fund. Keep doing your SIP, and the diversity of those funds and the performance of those funds. I'm confident that for next few years or next many years, they will keep doing well. Before we see that those variables have changed, we have greater institutionalization, low cost index funds are available, and a good part of the economy is also being actively traded, and investors can participate in those. So I look forward to your questions, and we'll keep a watch on this topic in times to come as well.
Thank you, Dhiren.
Thank you.
Our first question comes from Aarti. She asks, what should be the time horizon for investing in an index fund?
Your time horizon for investing in index funds should be the same as in equity, because when we are talking of index funds, we are talking primarily of equity investments, and I would say that all the methods of investing in equity should be followed. It should be your long-term money, and which means 5 years and more, and you should be investing regularly. The only thing that you should keep an eye on, or one of the biggest factors which you should keep in mind is which index and what is the cost, because that cost is going to be the only and the primary differentiator of an index fund.
Next up, Chirantan asks if you can explain what are Sensex Plus funds and if they give higher returns than Sensex funds.
Sensex Plus funds are the ones which says that this large part of the fund will be invested in the Sensex stocks. It could well be 70%. I can recall one Sensex Plus fund offered by a fund company which says that 70% of the money will be invested in Sensex stocks, almost in the same ratio, and at least in the constituents. And remaining 30%, the fund manager will invest in any other part or any other stocks. So it is trying to optimize, trying to derive the benefit of being in liquid, actively, fairly liquid, large cap stocks of Sensex, and also give a pointer or indicator or guidance to the investor that good part of your money is invested in Sensex stocks, and most of the value addition will be done in the remaining 30%. So it just gives you a greater predictability.
Next up, Mr. Shahapurkar asks if one should invest in the top 5 actively traded stocks of the Nifty rather than the entire index to get higher returns.
I don't know. Actively traded may not be the right indicator of it will be too realistic. It may not be the right indicator, because actively traded stock might be completely driven by the liquidity in the stock. For example, Infosys and Reliance Industry might be the most actively traded stock, but they may not be. The reason why one should invest in a stock is the outlook should be great and the stock should be underpriced, or the stock should be reasonably priced for you at any given point for you to generate returns out of it. So based on, if these are the two things which one should be keeping in mind, that the company will do well, so the stock will generate more return. I don't think that is getting factored in the the volume of trading or the most actively traded stock, so it should not be your guidance.
This next question is from Gajanan. He asks what is tracking error and if you can illustrate it with an example, Dhiren.
Yeah, tracking error is something which, a index fund is always tracking an index. So how efficiently it is able to track, assuming that a fund, there is a Nifty fund, there is an open-end fund which tracks Nifty, and the fund goes up by, the Nifty goes up by 1%, but the fund goes up only by 90 basis point or little less than 1%, or the fund goes, Nifty goes down by 1% and the fund actually goes up or down. It is not able to perfectly replicate the performance of the index. So the difference in the return on a day-to-day basis being added up over a period of time is the tracking error. How efficiently, because an index fund is supposed to give me no more and no less than the index, but tracking error arises out of 2-3 reasons. One is, in case of an open-end fund, the fund company gets the money on every day, and there is a cut-off time. It is generally 3:30, and coming from different modes. The fund company and it will come from a lot of small investors, a lot of large investors. Now SEBI has made it possible to ensure that units are allotted only after realizing the money. But realizing the money for use, for investment, does not necessarily mean that the money will get invested, the money will get deployed. So the fund company may get the money, issue the units to the investor, but may not be able to invest. And next day morning, when the fund company is investing the money in those constituent in the stocks, then it may not be the same price as yesterday. So yesterday's allotment has been done at yesterday's price. The other thing is that the time when the fund company buys those stocks is not the same as when it gets the money. So allotment of units happens at a different time, and purchase of those underlying stocks in the same ratio as the index happens at a different time. The second reason why there could be a tracking error is primarily the fund company gets redemptions and new purchases. Some people buy every day, some people sell every day. After aggregating, depending on the net position, the fund company will be buying those underlying stocks or selling some shares. In that situation, buying and selling may not be of a quantum which will be a round unit, because doing it with precision, that this much percentage of Reliance Industry has to be bought or sold, or the second position might be Infosys or State Bank, exactly in the same ratio. Because if the fund company on a net basis has got about 6 lakh rupees on a daily, one day inflow, or 3 lakh rupees of outflow, it may not be able to perfectly replicate place the orders or replicate the index weightings with the precise manner. The third reason why there could be a tracking error could be, which is actually not an error, because index funds do, the raw index that we see, whether it be Nifty or Sensex, which we read on, which is being popularly quoted, Sensex crossing 30,000, they are not dividend adjusted, because when you buy these shares exactly in the same ratio, you will also be getting dividends. And the dividend sometime in a poor market can well be 3.5% of the value on an annual basis. The second thing could be, and in the worst of times it is 1.5 to 2%. So that is the added return that you get. But that, to my understanding, and then comes the mutual fund expenses. Of course, that is not factored as part of the tracking error. So these are 2-3 reasons which can be an impediment of a mutual fund to precisely replicate the performance of an index with their own investments, that causes tracking error. And sum total of the daily variance between the index and the fund is captured in a standard unit over a defined time period, and that is referred as tracking error.
Moving on, Prahlad asks if one should invest in index funds now, considering that the indices are already at their peaks.
As I keep saying that, as I said earlier, that one should follow the same principles of investing in equity as investing in an index fund. It is just that you're not entrusting your money to a fund manager, but you are just going by the index. And if market go up and down, so will be an actively managed fund. So I would say that follow the same principle, invest your long-term money and do your SIP.
Next up, Himanshu asks that your recent column saying that the time for index funds is coming soon, does that mean that the average 12% return from long term mutual funds will come down?
I really don't know. I'm hopeful that index funds will gain prominence over time as markets more mature, becomes more efficient, becomes more institutionalized. More long-term money starts finding its way into index funds. That itself will drive up. But I don't know when it will happen. It might take a couple of years. It might take many years. I would still bet my money. I would still urge investors to consider actively managed proven fund managers. Uh, they are great value for money despite their cost.
Abhinay asks if he can invest in a small cap index fund.
I wish he could, and hopefully there should be some provision of enabling that. But right now we do not have a small cap index fund available. And in fact we have a couple of small cap index which are there. The BSE has it, NSE has it. Different variants of small caps are there. But we don't have index. We have the Nifty Junior, which I would say that is more like a multi-cap fund, or you have the Nifty the Nifty 50 Next, which is more like a multi-cap fund, multi-cap index. So there are other options, but right now in India we do not have a small cap index fund.
This next question comes from Mamta. She asks if she can invest in index funds directly.
Yes, in open-end index funds you can invest directly because the method of investing in them is exactly the same. The way you buy any other actively managed open-end equity fund, you can buy that from the fund website or from mutual fund utility.
This next question is from Munish. He asks what apart from expense ratio impacts the returns of index funds.
As I explained in the earlier question, one is the expense ratio, the other is the tracking error, how efficiently it will replicate the index, and nothing else, because these are the primary two factors. And I would say that tracking error can actually be positive or negative. Sometimes an index fund is able to generate little more return, and sometimes it is not able to, it generates little lower return. But primary differentiation is only the expense, and tracking error can actually work either way. So nothing else, just the expense.
Moving on, Mr. Vadia asks that once a distributor's code is tagged to an investment, does one have to necessarily sell it through the same distributor?
No, not necessarily, because today it is, most investors can redeem their investments directly as well. You don't, and basically your distributor only facilitates those redemptions. So, and with all your account statement on every purchase, there is a counterfoil attached to the account statement, which has, a form for additional investment and also a form for to request redemption. So you can just fill it up, sign it, and you are good to redeem your money directly.
Moving on, Deepika asks if equity savings funds are better than balanced funds.
They are very different from the balanced fund. Balanced funds typically are, for some historic reason, balanced funds are being called balanced fund, but they are no longer balanced fund. They invest normally between 60 to 70%, 75% into equity, remaining in fixed income. So think of it: 3/4 of your money is in equity, 1/4 of your money is in fixed income. These equity funds, the new format is quite different. It is 1/3 of your money in equity, 1/3 of your money in arbitrage position, which will generate return like that of a liquid fund, and 1/3 of it is in fixed income. So it is lower risk. The tax treatment is like that of an equity fund, is like that of a balanced fund, but nothing else. If the market, think of it: 2/3 of your money is in fixed income, which generates, assuming it generates 7% or 8%, somewhere between 7 and 8%, and only 1/3 of your money is in equity. Market goes up by 10%. As compared to a situation where the balanced fund has 75% of your money in equity, if market goes down by 10%, your 75 rupee invested in a balanced fund will lose 7.5 rupee. In case of an equity income fund, your 33 rupee of the 100 rupee invested in an equity income fund will go down by 10%, which will be 3 rupee 30 paisa decline, and the fixed income will go up. So the equity income fund are far lower risk because the allocation to equity is substantially lower, is half that of the balanced fund.
Next up, Aradhana says that as a practicing architect, her income is highly irregular. She gets a little over some months and then gets a substantial surplus in others. She says this makes SIPs difficult for her. So, how can she invest?
Invest when you get it, and if you are investing over when you have the money, and so and it's fine, it's perfect. It really all it will call for is that you have to be a little more disciplined. Whenever you have the surplus, invest that money, and invest the money with a time frame. I would say that somebody like you should create a reasonable reserve, should have the emergency money, so that you don't have to worry about your day-to-day consumption need. Assuming that your monthly expenses is say 50,000 or just for illustrative purpose, assuming that you have your monthly consumption need is 50,000 or 1 lakh rupees. So for next 1 year, put that money in a fixed income fund, or put that money in, or depending on your scale of urgency or scale of need or ad hoc requirement, 6 months to 12 months need in a fixed income fund, and start withdrawing from it with regularity. Then you will be free from the anxiety on a day-to-day basis, and then invest all the money that you are able to create. And whenever you are able to consume this, maybe replenish it over time. Keep a margin of 6 to 12 months, and keep investing all your monthly surpluses into equity. It will be less structured, but that is also SIP, because the whole idea of SIP is to be to be able to average your investments over time, reduce your anxiety with a lump sum investment. Don't accumulate your money in your bank account to invest at one go. So all that is, all the whole difference is that you will have to be a little more disciplined. Whenever you have the surplus, you should be able to invest it.
Next up, one of our viewers asks if it is prudent to invest in an index fund if he wishes to invest for 30 years.
Maybe not right now, because when I see the performance of funds over the last 15 year, 20 year, 25 year, 30 year, I find that at least for the fund which have existed for nearly 20 years, I find that 90% of the funds are able to beat the index by a wide margin, even though the index has done reasonably well. Then I find that the margin of outperformance is quite substantial, because on a 20-year basis, if you are able to earn even 3-4% more return, it looks 3-4%, but it is substantially more, and the impact of long-term accumulation over such a period is quite dramatic. So maybe not right now. At some point there might be at some point in future when index funds might look compelling. Also, somebody visiting value research coming and asking us, I'm confident that even when it gets difficult, I would like to tell our viewers that in America indexing is popular, but that doesn't mean that even in the US there are not too many, there are not funds which actually beat the index by a wide margin. In the US as well as UK, there are a handful of funds which have beaten the index by a wide margin over a very long period of time and reasonably consistently. Just that you don't have to beat the index every year. In fact, when I look at some of our funds, there are funds, when you look at something like Birla Sun Life Frontline Equity as well, which has a long history, in 2-3 years of its long existence, it has not been able to beat the benchmark. But the reward that has been derived from this fund, despite that underperformance underperformance relative to the benchmark in 2-3 years, is handsomely the handsome margin by which it has been able to beat the benchmark, more than compensates. In fact, it is much more than adequate compensation for 2-3 years of underperformance in a long history of 15-18 years.
Next up, Vishal asks, why can't we have a broad index ETF like Nifty 500 similar to the Vanguard's S&P 500?
It's hard to do in India because maybe it will get easier over time, because if you look at the state, the liquidity situation, the liquidity in the underlying stocks, because for an index to be properly replicated, it is a completely different thing to actually devise an index and calculate based on their prices every day in an Excel spreadsheet. Calculating index based on an assumption is different than running a fund based on those constituents, because then the fund manager will have to buy, assuming that this fund is created and tomorrow 5 lakh rupee gets invested in this fund, which means this 5 lakh rupee has to be spread over, the fund manager has to buy those 500 stocks exactly with the same, in the same proportion. It may not be that easy to replicate that, but we had one fund which was, the Sensex 500, which was being run as a active, as an open-end fund. Of late, I don't recall, it, and it never gained prominence. In fact, the case for indexing itself is so weak in India that people have not gone in other areas of, sophistication in creating different indices, index funds.
That's all we had time for in today's session, Dhiren. Any
Thank you.
closing remarks?
Indexing is being talked about, and John Bogle, the founder of Vanguard, keeps talking about it, and he was a special invitee at Berkshire Hathaway's annual meeting. We read the American textbook and find that the mention of index fund, Indian investors are also very curious. At Value Research, we get a lot of questions that why investors should not invest in index fund. Simply, we invest our money to maximize our return or to optimize our return, and index funds are shaping up well. They are gaining popularity, but I don't think they are still a vehicle to really optimize and maximize your return. Maybe there'll be a time, we'll keep watching, keep an eye on this. But right now, the case of an actively managed fund in India is very compelling. Be at it, be a regular investor in a well-managed fund, and let's not look at the downside of underperforming the index, as over a long period of time, over a longer time investment time frame, you are likely to be a winner.
Thanks, Dhiren.
Thank you.
And thank you everyone for joining in. Don't miss our next hangout where we reveal insights from the most comprehensive study ever done on SIPs. Do join us.